How much is your business actually worth? That's something that as a business owner, you may want to know at some point in time, especially if you plan on selling your business or even a stake in your business. Because, of course, you don't want to give it away for a little bit of nothing, right? I'm Kalila Reynolds, and it's time for another episode of Money Moves JA, brought to you in partnership with EXIM Bank's Business Advisory Service, giving you the tools to grow your business. Today, I'm joined again by Kevin Valley. He's Managing Director and a Chartered Business Valuator at Become Investible. Welcome back to Money Moves, Kevin.
Thank you for having me again. It's so much fun being on this show, man. Glad to be back again.
So the last time we spoke about becoming investable, we also touched on valuation. And so let's start by figuring out what is valuation.
Oh man, I love that. I love that question. It's a very catch-all question. Okay, so valuation is really about determining the worth of an entity. Right? If I could put that in layman's terms, it's about how much would that entity be worth in the market, or we use this term fair market value. So what's the highest price that this company or this asset could fetch in the market between, let's say, hypothetical parties that aren't under any compulsion. They're not being forced to transact. So they're transacting voluntarily. And this is on a cash basis. Or sometimes, it might include cash and stock or whatever it is. But yeah, so that's really what valuation is about. It's essentially the art and science of determining the worth of an entity or an asset.
So why is it important for a valuation to be done on your business?
Well, there might be a variety of reasons that you'll want to do a valuation in business. Most common, especially for small businesses, is that they might be looking to get capital to grow or scale their business, or they may be the target of an acquirer, so they may be interested in selling their business. When you look at the medium-sized business and the larger businesses, many times they may need to do a valuation just for financial reporting purposes or audit purposes, just to justify to the auditor, okay, well, yeah, this company, we're valuing this company properly. We're not overstating it or understating it. Another reason might be for tax purposes. And in markets where you have like those very complicated and layered tax systems, for example, Canada, the US, Australia, or what have you, you may want to get that valuation done just to make sure that you're being efficient on your taxes. Now, I would say I am not a tax expert by any means, but yeah, that's definitely one reason to do a valuation. Another reason you might want to do a valuation, let's say you own a business and you're getting divorced, so you're having a marriage separation, and you want to determine how we're going to divide the assets from the marriage, because as you know, unless there's some sort of prenup in place or whatever, it's typically assets are split 50-50. So you want to make sure that you and your partner, you and your ex-partner, are being treated fairly in that settlement.
All very good reasons. And then, of course, if you're getting an investor, you need to know what the value of that company is. If it's an equity investor and they're buying a stake in the company, how much should you sell it for? That's a very important question, and that depends on how much the business is actually worth.
Exactly, yeah. And evaluation would essentially be the starting point of that negotiation. It's very seldom that a business owner will take their company, take a valuation of their company to an investor, and the investor just takes it as given. It's always a negotiation.
Right, because you may be in a very high growth industry, or maybe you just signed a contract, and so the business in 5 years is going to be worth a whole lot more than what it's worth today. So you can use it as a negotiating point, right?
Exactly, yeah. So you want to look at, what's the addressable market? What's your growth potential? And I mean, even in looking at the addressable markets, so you could say that the total addressable market is something like 3 billion. But if at the end of the day, 2.995 of that 3 billion have never even heard of you, then I mean, is that really your addressable market? Is that really show growth potential? So addressable market and market opportunity is one thing, but you also need to be clear on your go-to-market strategy and your product market fit, as well as what makes you stand out in that market, why people will buy from you as opposed to other people who are already solving that problem that you're solving.
And you mentioned taxes as well, tax purposes. Right now, I am supposed to be filling out a statutory declaration. Do I put my business's value on there or expected value?
No, I did say I was not a tax expert.
Yeah, you did say that. Give that disclaimer.
But you see, you're still holding it. You're still holding that business. Usually, when the taxes comes into play is when you're disposing of an asset. So then you have to pay capital gains tax or what have you. So yeah. So if it's still being held in your portfolio, and again, this is my non-tax expert opinion. It's just me, my evaluator opinion, that you should still be able to hold it on your books as at fair market value, or even cost. So however much you would have invested in the business to date.
Okay, so now I come to the big question. How do I know what my business is worth? And I know, ideally it's best to just leave this to the professionals, find a valuator like Kevin Valley and have him do all the maths and tell you how much it's worth. But suppose I just need a ballpark figure for whatever reason. How do I get a good idea of what my business could be worth?
Okay, so you want to go ahead and perform a valuation of your business. All right. So, yes, that is a big technical endeavor. But what I can tell you is what I could go over with you is what actually determines or influences the value of your business. So, just kind of start at the high level and just kind of zone down. Usually, valuation is done on two main bases. That's a liquidation basis. So, let's say that your business does not seem to be a going concern, and it's not not expected to generate profits in the near future for investors, and you expect to have that business that's closed down. So you'll do a liquidation valuation there. Then there's the going concern basis. So this is where you expect your business to be able to generate healthy profits for investors in the long term, right? So most of us will be doing a going concern valuation. All right, so now that you're doing a going concern valuation, there are three methods, right? Well, sorry, three approaches that you'll use to do a valuation. There are the asset approach, so that's the asset or cost approach. So that assumes substitution. That is saying that a market player will not necessarily want to pay more for a business than it would cost to reconstruct that business himself, right? So you look at replacement cost or that sort of thing. All right, and then you have market approach. That looks at the cost of, that looks at what companies like your business are currently being traded for on the public stock exchange, or what have private companies been sold or purchased at, in the market. And then you have the income approach. And this is where we'll focus our attention, because again, this income approach is based on future cash flows or future earnings, future profits, or future cost savings. All right. And then you want to look at what determines your value of your business, right? So what gives your business a defensible valuation? So like I was saying earlier, a valuation is usually the starting point of a negotiation, be it for financial reporting with auditors or what have you. You always have to defend that valuation. If you want to go to an investor or an acquirer, you have to defend that valuation. So I've come up with, just been through doing my analysis and whatnot, I've come up with 7 main factors that determine the defensibility of a company's valuation. All right, and again, I'm going to start top down, right? So the first thing is the market environment, and this includes the economy, industry, and then it kind of goes on into competitive advantage. So economy. So you're looking at the economies that the company's customers are in, or that the company serves. So if you have a company that has head office in Jamaica and Trinidad, you want to look at, okay, so what's the economic growth rate or forecasted economic growth rates in Jamaica and Trinidad? You want to also look at the particular industry that you're in. So, we talk about headwinds and tailwinds. Headwinds refer to trends that could go against you, that could go against the favor of your business. So, example, you're in the fitness business, or you're in your barbers, or you're in any business that require people to be close and intimate, COVID-19 was a headwind for you. All right. Tailwinds now. These are trends that kind of push you forward. They propel your business. So you're in the business of doing online virtual events, online virtual communication, that kind of stuff. COVID-19, I mean, as bad as it was a tailwind for you. All right, and then it kind of goes down into your competitive environment. So what makes you different than other players in the market? All right. So the second factor would be the management. Who are the people on the team? Who are the people running the business, and how deep is the bench to make sure that the company could execute on what it set out to execute on? Third, and this is a big one, the third one is the cash flows. All right. So most of the income approach valuations, be it discounted cash flow, capitalized earnings, discounted future earnings, what have you, they're based on the cash flows of the business. So of course, this comprises of your revenue generation, right? So we spoke about product market fit, identifying a target customer, how you're maintaining those relationships with those customers to keep them coming back, and so on. Then you have expense control, right? So how's your relationship with your suppliers? Or what about how are you paying your staff members, your team members, or what have you? And I mean, just want to stick a pin right here. A very important thing to look at when valuing, especially small businesses, is an acquirer. When somebody's going to acquire your business, they're going to assume that they're going to be paying market rate salaries. So a lot of small businesses, because they're starting out, the owner/operator might say, okay, well, I'll take a very nominal salary. I won't take what I would be able to fetch in the market if I were to go and get a job. Mm-hmm. When doing a valuation, you wanna assume that, because again, you're looking forward into the business, and you're gonna assume that when the business has been acquired or whatever, you're gonna be paying market salaries. Usually what people do is they deflate their salaries. No.
Oh, deflate.
Yeah, deflate, because your business is small. You want to keep your expenses low. So you say,
no, but I mean, when you're about to sell, because you'll deflate the salary now because you're managing all the expenses yourself, yes. Right. But when you're about to sell, you're going to inflate your salary. That's what a lot of people do.
No, you're not. Well, you're not supposed to. You're not supposed to inflate it. But what you want to do, you want to map it to what a market person, so what a market CEO would receive, or a market CFO would receive. Just again, because you want to be prudent, you want to make sure it's defensible, you want to make sure it's something you could justify.
Right. But I figured that cash flow would be a very important one in determining valuation. As a small business owner, you tend to think, okay, so my business is bringing in $20 million a year, so I have a $20 million business. But you're saying that there's much more that goes into it than just the cash flow.
Yeah. So there's more. Sorry, I know I spent some time on the cash flow. All right. So aside from the cash flow, you have what's the cost of capital, right? So, and again, this is based on your capital structure, how much debt you have in your business versus how much equity you have in your business, and those your debt and equity would have required returns by those investors. So for equity, you're looking at your risk-free rate, the premium for being equity versus debt, and of course, your company-specific risk and what have you. Various risk premiums. Then you want to look at your financials. You want to make sure these financials are reliable. So are they been prepared by an auditor? Are they prepared by a certified accountant? Are they management prepared, or do they even exist? Right? Many times you don't have financials and stuff in place. And another aspect of your financials is your asset base. So a nice sanity check for the minimum level that your company should be worth is the value of the actual physical assets within the business, right? Because if, for example, again, going back to liquidation, if you have to sell your business in a fire sale, it might just be worth what the hard assets are worth in the market at that point in time. So that would be like the floor level of your valuation.
And does that include your trademarks?
Yes. If your brand, yes, because your brands would have value, and the trademarks are the intellectual property that protect your brands. So yeah, if you're able, if your trademarks have value, if your brands have value, and you're selling your business to somebody else, yes, that intellectual property does have value in the marketplace. And I mean, IP valuation could be a separate valuation as done, and yeah, that's a service that I offer as well. All right. So aside from financials, the sixth thing is of course, your strategy, right? So your strategic planning, review, implementation, the forecast that you prepare, your financial forecast that you prepare for your business, that a valuator will take on discounts or whatnot, and then also your track record in hitting your forecast. So if your forecast always looking like this, but you never really achieve them, then a valuator, an investor, an acquirer, or even your auditor might look at it and say, all right, let's just discount that by 50, 60, 70%. All right. And the last thing that determines the defensibility of your valuation, of course, is your systems. So your operational systems, your procedures in place to make sure that you could continue serving your customers, that you have business continuity, or maybe even like customer data protection, digital transformation, digitalization, and that sort of thing. So I know I said a lot just now. Just to recap the 7 there. You have market, you have the market environment, you have the management team, you have cash flows, you have cost of capital, financials, strategy, and your systems.
Very good. So Kevin, before we go, I hear you have some big stuff coming up. What's that?
Yeah, so at the Become Investible side, we've been working on a few years on developing our methodology, and it continues to improve, right? Those whole 6 metrics that we look at for companies to determine how investable they are, if they are ready to go ahead and attract the funding they need to scale a business. So we have a scorecard that's coming up, and it will definitely be out by the time this interview is. And people could go ahead and click through the scorecard. It's going to take about 10 minutes, and it's some questions, yes, no, yes, I have this, maybe, what have you. And we're going to evaluate your company based on our 6 metrics again. That's, the people, your customers, your competitive advantage, your corporate governance, your financial controls, and of course, your financial data, which indicates if you're ready to face investors. So in doing this report, you'll also get a gap analysis on what's missing in your business and how you could go ahead and close those gaps. So you could go ahead and log on to becomeinvestible.com. That's becomeinvestible.com, and go ahead and take that scorecard. All right. Kalila, thanks again for having me. This has been amazing.
Thanks, Kevin. Looking forward to it. I'm definitely going to click on that link. I want to know what KRM is worth.
Well, my guess is a lot.
Let's get this money. Thanks, Kevin.
All right. Bye-bye.
And here's a recap of Kevin's main points. A valuation is an assessment of the worth of an entity or asset. There are 3 approaches used when determining the value of your business. They are the asset approach, the market approach, and the income approach. The minimum that your business should be worth is the value of the company's physical assets. That's it for this episode of Money Moves JA, brought to you in partnership with EXIM Bank's Business Advisory Service, giving you the tools to grow your business. Visit their website, eximbankja.com, and visit my website, KalilaReynolds.com, for a summary of this episode.
Let's get this money.